Hi, this is Alan Gassman. I'm here with Brandon Ketron, and we're going to talk for about 30 minutes on coronavirus planning pointers. We've been giving webinars. We're going to send everyone in this webinar a copy of the PowerPoint and a list of the other webinars and where you can click to watch them. This is kind of a jack of all trades webinar and a webinar to clean up some questions that have come up and some things that we haven't covered yet. You've got a table of contents here at page 2. I'm not going to read you the table of contents, but you may want to go through that to get a view of what we're looking at. We have a checklist of what advisors need to know now to advise clients on page 3. I'm not going to stop for that either. I'm going to go to page 4. Most tax advisors are not aware that the CARE Act put into place a new provision under IRC Section 139. We are waiting for formal confirmation that this provision will apply to everyone impacted by the virus. Some experts think it already applies. Some experts are waiting for a little bit more verification from the Treasury Department. This allows the employer to receive a full deduction without paying payroll taxes, without making a pension contribution, without paying unemployment expense, etc., if they are paying an employee under 1 or 2 to reimburse or pay a reasonable and necessary personal, family, living, or funeral expense incurred as the result of the disaster, or number 2, to repair or rehabilitate a personal residence or repair or replace its contents. So you've got babysitting expenses, you've got some families, unfortunately, who are going to have funeral expenses, you're going to have home computer setup expenses, multiple phone line expenses, buy a fax machine expenses, and all of those are going to provide a nice tax deduction for the employer and no income to the employee, just so you're aware of it. And using this code section doesn't prevent you from also borrowing and things like that. On the charitable side, for individuals who don't itemize their deductions, they can get a no questions asked $300 deduction for donating to a charity. For individuals who are bigger donors, they can now give up to 100% of their adjusted gross income to charity during 2020. And if they itemize, of course, they will get a deduction for all of that. A lot of people have been deducting 50% of adjusted gross income, giving appreciated assets away. Well, there aren't as many appreciated assets as there were. And if you give cash, you can fund your family foundation or a public charity now, a family operating foundation, up to 100% of AGI. So don't forget about that. Also, before I forget, in case we don't have a slide for it, net operating losses. If you or your client had a loss in 2008, 2009, 2010, etc., and you didn't carry it back, you haven't made full use of the loss, how does that work today, Brandon? How can they now get full use of a loss that they've been carrying forward?
Yeah, so as part of the CARES Act for 2020, we now have a 5-year carry back period that you can carry back that loss. So if you had a carry forward loss and you had income in 2018 or 2019 or even before then, so we can go back a full 5 years, 2016 tax year, to use that loss to offset income and get a refund from the IRS this year for use of the net operating loss. Same thing would apply for 2018 and 2019. If you had a carry forward loss in those years, you can amend the 2018-2019 tax returns to take advantage of this 5-year carryback period.
Okay, very good. Now, page 10, don't forget the $100,000 withdrawal right that people have over their IRAs and now pension and profit sharing plans, if the employer permits this, or if it's in the plan, or if it will be added to the plan. They can take the $100,000 out now, and they can decide whether to put it back or to pay tax on it as if it was received this year, or to pay tax 1/3 this year, 1/3 next year, and 1/3 in 2002. We discourage people from taking money out of their plans because it's not creditor proof once you take it out and for other reasons, but it's still an opportunity. It's a way to get some quick cash into the system, which is what the government is looking to do. The 10% excise tax for withdrawals for people under 59 and a half will not apply. In addition, the old $50,000 loan that could be taken out of certain profit sharing and pension plans was increased to $100,000, and the repayment arrangement was stretched out. So now some people will get $200,000 out of their pension plans. 100 is a distribution, 100 is a loan. But again, I'd rather see the client sell the boat or the vacation home before they reach into their pension plan. And yes, they won't be able to get as much for the boat or the vacation home as they could have before, but that has to be life in the big city. When the recession hit, we saw vacant property go down in value by 77% on average in Florida. We saw other real estate go down 60 to 70% on average. We saw boats go to 1/3 of what they had been purchased for. So you might want to unload these things sooner rather than later and make sure clients understand that when the virus thaws, we cannot predict what the recession is going to be like. Page 17, for those of you who may never get your PPP loan, or in case you won't get your PPP loan, please know that if you satisfy one of the two prongs below, which is that the business is fully or partially suspended due to orders from the government authorities, or gross receipts are less than 50% of what they were in the same last year for the same quarter, then you can basically just get paid from the government $5,000 per employee. So this is nothing to sneeze at. If you have 10 employees, that's $50,000. But if you do this, you can't take the PPP loan. So when you have clients that are applying for the PPP loan, you need to tell them about this credit. Maybe clients have 3 or 4 different companies. One company will take the PPP loan. One company will take the credit, depending on how many employees there are. But at least this credit is in your back pocket, even if you don't get the PPP loan. And we have an example for you there on page 18. Now, you can also delay paying your payroll taxes. That's the 6.2% that you take out, that the employer puts in for payroll taxes, pay half in 2021 and half in 2022. But if you do this, then you will not receive loan forgiveness under the PPP plan. So this one, I think you want to delay doing. Brandon and I don't think we know whether you can take advantage of this and then suddenly stop taking advantage of it, make a makeup payment when you finally get your PPP loan. Brandon, do we know?
Yeah, I don't think we know. I think we can go ahead and get the PPP loan. There's no provision that you can get that you cannot get the PPP loan if you delay the payment. It's just if you receive any forgiveness of that loan, you're not eligible to defer.
So I would pay the 6.2% payroll tax for the employer until you know what you're doing on the PPP side. Now, at slide 20, this should be the most valuable thing we're providing. We're explaining the EIDL loan on the left and the PPP loan on the right. We have just cut an hour-and-a-half webinar. Actually, it came out to about an hour and three-quarter webinar on this for the Lineberg program. If you have no payroll, or you don't want to wait for the PPP loan, or you're going to need more than that, or you would like to get a free $10,000, then definitely go to this website, which is the SBA, and apply. And the vast majority of small businesses and independent contractors, including Uber drivers, are going to get a $10,000 payment within 3 days. Although it's been about 7 days since we applied, we have not gotten our $10,000 payment. We'll let you know when we do. But it's very simple, and it doesn't require any payroll to get the loan. The SBA has said nothing and published nothing about what they're going to do if and when above the $10,000 amount, but they have the ability to loan up to $2 million per borrower, and it can be used for all these different things. So it can be used to keep real estate businesses afloat if they will activate the program. On the right-hand side, we have the PPP program, Paycheck Protection Program. I'll oversimplify this. You take your pre-virus average payroll cost for 12 months, you divide it by 12, you multiply it by 2.5, and that's the amount of the loan. If I have a $120,000 payroll cost for the 12 testing months, divide that by 12, it's $10,000 a month, multiply it by 2.5, that's a $25,000 loan I'm going to get. 10,000 of it I'm going to have to pay back because of the 10,000 I got under EIDL. It converts your EIDL free 10,000 into not free, basically. And then if I spend the amount that PPP gives me over 8 weeks from the time it gives me that amount on these items, which include payroll, healthcare benefits, pension benefits, sick pay, interest, and rent, then I never have to repay it. So that's the nice thing about the PPP loan. Now, page 22, you see the EIDL loan is up to 2 years. The PPP loan, you have to repay it within 2 years to the extent you don't spend it. Another great chart is page 23. Again, the PPP loan. First column, how much can I borrow? Second column, how much can be forgiven during that 8-week test? Third column, what I can use the funds for. Once I get the loan, if I don't use the funds for these items on the third column, then I could go to jail. But to the extent I use them for the items on the second column, I don't have to pay it back. Your bankers are working hard getting ready to take applications, but there's certain things that are simply, at this point, unknown. For example, one part of the law says that your 2.5 months would include only salaries up to $100,000 per employee. Another seems to say that you would limit combined salary and benefits to $100,000 per employee. No part of the loan tells you what the 12 months are. One bank says it's 2019. One bank says it's your choice of the fiscal year ending December 31st, January 31st, or February 28th, 2020. The other question that hasn't been cleared up yet is whether the repayment over the 8 weeks gives you credit for what you withhold from the employee's salary. ADP, for example, has done a really nice thing. They gave a website for all of their customers to go to have the calculations made, but then ADP made a mistake on how they're making the calculations, so the web page is going to mislead a lot of people rather than help them. So that's a short reason as to why your banker hasn't called you yet. It's not that she doesn't love you. She's going to get paid 5% of the amount you borrow on the first $350,000, and then on a sliding scale above that. So she definitely loves you, but they don't know their own rules yet, and that's not their fault. The Treasury Department's handling this and doing the best it can under the circumstances. So again, under the PPP, you'll measure compensation for some period of 12 months. You won't include people who make more than $100,000 a year. Then you'll get your loan, then you'll spend it within 8 weeks. That's the way they work. Now, one thing that's complicated, and Brandon, I think your slide is what, at page 28?
Yep.
Okay, so the big question we get asked is, hey, Alan, shouldn't I lay off all the people I don't need now, tell them I still love them, I'll bring them back for sure, let them get unemployment plus an extra $600 a week under the general federal program. Then when I get my PPP loan, I will bring them back and everything will be perfect because that PPP loan will cover 8 weeks of getting my business back. So Brandon, what happens based upon if you terminate that employee now or up through April 28th and then bring them right back, or you terminate them after April 28th or after April 27th and bring them right back.
Yeah, so just as the general rule here is that if you're comparing your number of employees that you had for last year over the number of employees you have during this 8-week period. So if you had 20 employees last year but only 19 during this 8-week period, you're going to lose 5% of the amount that can be forgiven. Now there's an exception in the rule where it says if you fire someone between February 15th and April 27th and bring them back prior to June 30th, we'll disregard the fact that they weren't on the payroll during that 8-week period, as long as you bring them back by June 30th. Now, if you let them go after April 27th, so let's say you let them go on May 1st, you don't have that exception anymore. You can't bring them back by June 30th to have everything forgiven. You have to have them on your payroll during that 8-week period in order for them to count. Otherwise, you're going to have your loan reduced accordingly. So a little bit of confusion there as to how that rule applies. But I think as long as you bring everyone back the day you get that PPP loan and have them on the payroll for 8 weeks, you'll be fine. If you fire someone during that 8-week period and it's after April 28th, you're going to have a portion of your loan reduced unless you can somehow immediately turn around and rehire someone to replace them. Now, if you have the 8-week period between that April 27th, before that April 27th date, and you bring them back by June 30, it's as if they were on the payroll during that 8-week period, and everything will be fine. So hopefully that clarified some of the confusion there on that issue.
Well, at least it lets us know that there is an issue and something to read about. Mm-hmm. And I apologize that we're, trying to go so fast here, but we promised this to be a 30-minute webinar, and a lot of you on this webinar actually know as much about some of this stuff and more about some of this stuff than we do. So we came up with 10 planning opportunities just to think about. Number one, apply for EIDL, get your $10,000 under each separate entity that was detrimentally affected by the virus. Number two, the employees making over 100,000, that's not going to, anything over 100,000 is really not going to account. You can either reduce those related party employees or other employees to zero until April 27, bring them back April 27 at 100,000, or maybe bring them back in case there's a gap, in case, for example, they're sick. When your loan comes in during the 8-week period, you had an employee who was employed by you through April 27, but she's sick during that 8-week period. The payment you give her when she comes back to work could count towards your forgiveness in that 8-week period, as Brandon said. This may also be a good time if your spouse is doing work, but you've been underpaying your spouse to avoid taxes. Go ahead and bring your spouse up to $100,000 during the 8-week period. As long as they're actually earning that money, that could help you meet the forgiveness test. Number four, again, reasons to bring people back by June 30. Number six, I said if you have multiple businesses, you can be doing multiple loans. Number seven, consider that $5,000 per employee payroll tax retention credit if you need the money now and it's not much more than your PPP loan, or if you can't get the PPP loan. Number eight, if you have 500 employees, you can't get into these programs, so you may want to convert some of them to independent contractors. By the way, it's clear now that the government intends that money you pay to independent contractors doesn't count in the 2.5 times test. It doesn't count in the 8-week forgiveness test, and independent contractors can file their own claims, and what their income is considered to be the amount to divide by 12 and multiply by 2.5, and then their forgiveness is what they can actually pay themselves, but their maximum PPP loan for a sole proprietor or an independent contractor is $37,500. A lot of those people don't even know about this, so you need to tell them about it because they need it more than almost anybody. Number 10, remember that the PPP loans are non-recourse, no collateral needed. whereas the EIDL loans have some degree of recourse and collateralization as well. So Brandon, I think I've covered the PPP. We've got the actual applications here for you. There's not a lot you need to know. Brandon, what do they need to know that they wouldn't know off of the top of their head for the EIDL application?
Yeah, so most of the information here is fairly self-explanatory, but these two items here, gross revenues and cost of goods sold, are really what you might actually have to pull from some report, or maybe contact your CPA or financial advisor that would have this type of information. Otherwise, most of the info here you're going to know on your own. You'll see here there's certain items that don't necessarily apply to everyone. You don't have to fill those in. You just leave them blank. The only thing you have to fill in on these applications, or anything with the red arrows on the left-hand side, those will turn green when the field's filled in properly, and then you can advance the slides. So
now you see fields here for rental property operations, and I expect that there will be guidance on how landlords who lost a lot of rent income during the virus will be compensated. There's a section here for not-for-profit cost of operations, so they will be friendly to charitable organizations who need to use this money to make up for what's happened during the virus, or to help the causes they help during the virus. And then you have secular social services provided by faith-based entity lists. So they are encouraging not-for-profits and religious organizations to participate under this loan program. Now, the PPP loan is a slightly more difficult loan. It's not a lot more difficult to apply for. We don't really need to go over this. You'll be working with your banker on this, but you should be gathering your materials. You should be asking your pension plan people for confirmation of what you put into the plan in 2019. You should be asking your payroll people for confirmation of payroll for 2019. And you should be asking your health insurance plan for confirmation of what you put into health insurance for 2019. And the regulations say that the bank is supposed to also get canceled checks. So they must have pulled this off of something from the late 1800s, because most of us don't get canceled checks anymore. But if you need something to do and you're getting bored, going through these slides, going through our webinar, and getting ready for this is a good idea. Family installment sales. If you are in an estate taxable situation, you're over the $11,580,000, or you recognize that it's probably going to go to half to that sooner rather than later, then it's a great time to sell assets at their low values to a trust for your descendants in exchange for a low interest promissory note. We have nice low values. We have what I call the VD, the virus discount, above and beyond the discounts you were taking, which may be 8 to 10%, because no one knows what anything's going to return to in value if it's not a marketable security. So this is a really, really good time. You can make a 9-year loan to a family member right now at 1.44%, a 9-year loan at 0.99%, and a 3-year loan at 0.91%, and that's not considered to be a gift. You could also do all the normal dynasty trust planning, and if your client has the virus, you can convert the note that they are owed to self-canceling until they recover from the virus, and then convert the note back. That assumes that they have better than a 2-year chance of surviving, better than a 50% chance of surviving 1 year at the time that you make the promissory note cancel upon death. I think the professional advisors understand what I said. Everyone else on the call, I apologize. Just wanted to let everyone know that the opportunity is out there. I'm sorry I don't have more time to explain it. We do have a YouTube webinar on installment sales by Christopher DiNicolo. If you can't find that on YouTube by searching those words, you can email us and we'll be glad to send you a link.
There's definitely a link in the slide too.
Oh, okay. There's a link on the slide.
Yeah.
Very good. So, There's another complicated way that we invented to use the life expectancy of someone who's not in great health without triggering any gift tax. We call it the SCRAT. It's explained on page 54. We have already met with some clients who are not in great health. If they get this virus, they would not have a good chance of surviving it. So we've been putting these into place. So Brandon, I went too fast. I have 4 minutes left. What did I miss?
Yeah, I think we covered most everything. I guess just to go back and touch on a little bit more on these loan programs, I think that's what a lot of people are talking about. Just to cover some of these traps, I don't think we covered this slide. So number one, just if you reduce your employees while the loan is outstanding during that 8-week period, or you reduce their salaries by more than a 25% reduction for those making under $100,000, remember we can disregard anything over $100,000, then a portion of your loan is going to be forgivable. Now, as we touched on, if you do that before that April 27th date and correct it by June 30, you're okay. If it's after that April 27th date, you have to correct it almost immediately during that 8-week covered period to avoid the reduction. Another thing is your EIDL loans and PPP loans can't be used for duplicative purposes. So we typically would use the PPP loan for payroll and those other permitted costs, and we would get EIDL loan for other expenses. And actually now on the PPP loan application, they have a spot to where if you're rolling over that EIDL loan, you're only planning on using the EIDL for payroll, you're required to roll it over into this PPP program and then get the full thing forgiven. And there's places on the application that disclose that and put the amount of your outstanding EIDL loan. If you get the PPP loan, you're not eligible for that wage credit that Alan discussed on the payroll taxes. And then if you also get forgiveness under the PPP loan, you're not eligible for the payroll tax deferral. So we want to make sure we're coordinating those two together. If we don't think we're going to get the PPP loan forgiven, we might be better off in the payroll tax retention credit, especially for larger businesses with over 500 employees. That payroll tax retention credit can provide a good benefit. 75% of the payroll protection loan has to be used on payroll costs. That was added as part of the regulations. That wasn't in the statute. So if you use less than that amount, you're going to have the amount that can be forgiven reduced accordingly. We talked about the compensation over $100,000. There's the confusion on whether it's net wages or gross wages. I think a lot of the comments that we're hearing is that it was the intent of Congress that gross wages would be used, not the net. So I think a lot of the applications now, and most of the banks are using gross wages to calculate this, even though the statute says something just slightly different. If we live outside of Florida, we want to check our state law income tax consequences. If we get this debt canceled, we know federally it's not subject to income, as would typically be when you have debt canceled. But we're not sure which states are going to actually come into compliance with that. Some might exempt themselves back out and make that taxable in a separate state. Not an issue here in Florida since we don't have income taxes. If you're using the payroll protection loan to pay rent, lease, that lease has to be in place before February 15th to be considered. If you modify it afterward to increase the rent amount, thinking that you can use the payroll protection loan to cover it, that's not going to work. It has to be in place prior to February 15th. And then as Alan mentioned, unemployment right now with the additional $600 benefit might be the way to go temporarily until we can get this PPP loan in place, or the business is back up and operating. Maybe we defer the date that we can get the PPP loan if possible, if we don't run out of funds first, till we get back up and going, till this quarantine order is over. So then we have the PPP loan to help us get rent back up once businesses are back open again. So I think that just touches on some of these traps, and we talked over the planning opportunities that were available. Alan, anything else you want to add there?
Yes, Brandon. We forgot to mention one very important thing, and there's a lot of people on this call that it impacts. If you have real estate that is highly leveraged and it is in your personal name or an LLC that's disregarded for income tax purposes or an LLC taxed as a partnership, please immediately call your tax advisor. Email us for a copy of our white page on why you may want to prepare for a retroactive S election and immediately update the operating agreement of the LLC or the partnership agreement of the partnership that owns this leveraged real estate. Because when you do a bank workout, if the owner of the property that gets debt reduction or a foreclosure occurs is an S corporation, the income from the reduction of debt will typically not flow through to the shareholders. On the other hand, with a partnership or a proprietorship, in many situations, the reduction of debt causes taxable income to the taxpayer unless it occurs in a bankruptcy. So even if you paid $1 million for a piece of land, you have $1 million basis in that piece of land. You owe the bank $700. The land goes down to $500. You pay the bank $50,000, and they take the land, and you're done. Even though your basis in the land was $1 million, the government considers your basis for ordinary income calculation purposes to be the fair market value, which is $500. You've just sold the land for $750. You've got a $250,000 gain or a $250,000 debt reduction, depending on how you look at it. You pay tax. It's a sad day. On the other hand, if that operating agreement allows S election and you have 75 days, you can wait until the virus thaws. If there's no recession, you can leave your entity taxed as a partnership. If there is a recession, you can backdate your S election up to 75 days as long as the operating agreement allowed an S election on that day, which is why you need to modify the operating agreement now. We call that the CREST technique, C-R-E-S-T, and we'll be glad to send you the white paper on the CREST. If you send us a request, put R-E CREST, C-R-E-S-T. Brandon, anything else?
I think we're good. We're just a little bit over, which is typical for us. So it was good.
Yep. All right. Well, we welcome any questions, comments, and suggestions. Thank you for supporting our efforts by giving us questions. Please feel free to forward this. You're going to get a link to this webinar with the PowerPoint later. Please feel free to forward it all you like. I posted a Forbes blog yesterday on what to do for insolvent businesses, and I posted a Forbes blog as well about Governor DeSanto's last order on the stay-at-home order. If that's of interest, you can go to the Forbes blog. Just search Forbes, F-O-R-B-S Gassman, G-A-S-S-M-A-N. Those will come up for you, and then they will link you to the webinars that we've done on those topics. May the rest of your day be productive. May everyone be safe, and may we all stay forever young. Thank you.